Copy if the Strait of Hormuz stays closed for longer than a few days, this stops being an oil story. It becomes a global supply chain story. Because that narrow corridor of water, 21 miles wide at its narrowest point, is not just where oil flows. It is where a significant portion of the materials that power modern civilization move every single day. Semiconductors, fertilizers, industrial chemicals, liquefied natural gas. The systems that feed people, run computers, and manufacture the technology that the global economy depends on all have supply chain threads that run through that strait. And when those threads break, the disruption does not stay in one market. It propagates across the entire interconnected system of global trade in ways that most people and most news coverage never fully explain. That is what this video is about. Not the politics, not the conflict itself, the economics, the mechanisms. The way a disruption in one narrow part of the world can move through supply chains, energy markets, inflation data, central bank decisions, and financial markets in ways that take months or years to fully work through the system. Let's start with why the Strait of Hormuz occupies such a unique and irreplaceable position in global trade, because understanding the geography helps explain why no disruption of this strait is ever just an oil story. The strait connects the Persian Gulf to the Gulf of Oman and from there to the broader Indian Ocean and global shipping lanes. On a normal day, approximately 20% of the world's total oil supply transits through this corridor. That includes crude oil from Saudi Arabia, the UAE, Kuwait, Iraq, and Iran, along with liquefied natural gas from Qatar, which is one of the world's largest LNG exporters. There is no viable alternative route for most of this volume. The pipelines that exist to bypass the strait have a combined capacity that can handle only a fraction of normal transit volumes. And even those alternatives require time to activate and have their own vulnerabilities. When the strait experiences a significant disruption, the oil that cannot move does not automatically get rerouted. It simply does not move. That means the global oil market, which operates on relatively thin inventory buffers, begins to feel supply pressure almost immediately. The speed of that pressure depends on how long the disruption lasts and how severe the restrictions on shipping traffic become. The transition from normal operations to a situation where shipping traffic drops from over 100 vessels per day to a handful is not a gradual adjustment. It is an abrupt shock to a system that was calibrated for a very different flow rate. And oil markets, which trade on expectations as much as on physical supply and demand, begin repricing that shock before the first barrel fails to arrive at its destination. The oil price mechanism is the most visible channel through which a Hormuz disruption moves into the broader economy, and it is worth understanding precisely how that transmission works rather than treating it as a vague connection between conflict and prices. When oil supply is disrupted at the scale that a Hormuz closure creates, the immediate effect is a spike in crude oil benchmarks. That spike then moves through the economy in several distinct waves. The first wave is at the pump. Gasoline and diesel prices begin rising within days as wholesale fuel markets reprice the expected cost of crude. For consumers, this is the most immediately visible effect, and it has a direct impact on disposable income. A household spending significantly more on fuel each month has less money available for everything else. That reduction in consumer spending power is deflationary in some parts of the economy and inflationary in others, because the cost of transporting goods also rises with diesel prices, which pushes up prices for virtually every physical product that moves through the supply chain. The second wave affects industrial inputs. Manufacturing, agriculture, construction, and shipping are all energy-intensive industries. When energy costs rise sharply, the cost of producing and moving goods rises with it. Those cost increases get passed along the supply chain and eventually show up in consumer price indices as broad-based inflation. The third wave, which takes longest to develop but is often the most persistent, is the repricing of inflation expectations. When consumers, businesses, and financial markets begin to expect that higher inflation will persist, they adjust their behavior in ways that can become self-reinforcing. Workers demand higher wages to compensate for rising prices. Businesses raise prices preemptively to protect margins. Landlords adjust rents. Each of these adjustments adds to the measured inflation rate and makes it harder for central banks to bring inflation back down without aggressive intervention. Here is the dimension of this crisis that most economic commentary misses entirely, and it is arguably the most consequential one for the global economy over a medium-term horizon. The Strait is not just an oil corridor. It is a chemical corridor. And one of the chemicals it delivers is so fundamental to modern industrial production that its disruption creates cascading effects that most people would never connect to a Middle East conflict. Approximately 92% of the world's sulfur supply comes as a byproduct of oil and natural gas refining. Sulfur is processed into sulfuric acid, which is one of the most widely used industrial chemicals on Earth. Sulfuric acid is essential for extracting copper and cobalt from ore. It is essential for manufacturing the electrolytes in lithium-ion batteries. It is used extensively in semiconductor fabrication processes. It is a critical input for producing phosphate fertilizers. When refining operations are disrupted and sulfur supply tightens, the downstream effects move through four entirely separate and critical industries simultaneously. Consider the fertilizer connection specifically. Approximately 33% of the nitrogen fertilizer components that global agriculture depends on move through the Strait of Hormuz. A sustained disruption in fertilizer supply does not show up in crop prices immediately. It shows up in the next planting season, when farmers reduce applications because input costs have risen or because supply is unavailable, and then in the harvest after that, when yields are lower than they would have been. Food price inflation driven by a fertilizer supply shock is among the most socially destabilizing forms of inflation because it affects the most basic and unavoidable category of household expenditure. Now let's trace the connection from the Strait to the semiconductor industry, because this is a supply chain story that is almost never told in mainstream financial coverage despite being deeply consequential. Taiwan produces approximately 90% of the world's most advanced semiconductor chips. TSMC alone is responsible for fabricating a significant portion of the logic chips that power smartphones, data centers, artificial intelligence systems, and automotive electronics. Taiwan's manufacturing sector is heavily dependent on energy, and a meaningful share of that energy comes from liquefied natural gas shipped through the Strait of Hormuz. Qatar, which is one of the world's largest LNG exporters, routes a significant portion of its exports to Asian markets through the strait. Taiwan's strategic LNG reserves are measured in days, not months. A sustained reduction in LNG supply creates direct pressure on Taiwan's electricity generation capacity, and a reduction in electricity availability for TSMC, which operates some of the most energy-intensive manufacturing facilities in the world, creates direct production risk for the global semiconductor supply chain. South Korea faces a structurally similar vulnerability. South Korea is the world's largest producer of memory chips, including the DRAM and NAND flash memory that data centers and consumer electronics depend on. South Korea is highly dependent on Middle East oil and gas imports. A significant and sustained rise in energy costs hits Korean manufacturing economics hard, and the financial markets reflected this connection almost immediately when South Korean equity indices fell sharply, with major semiconductor companies seeing some of their largest single-day losses in decades. When the energy infrastructure that powers chip manufacturing is disrupted, the effects eventually show up in the cost and availability of every piece of technology that depends on those chips, which in the current economy means nearly everything. Let's talk about what all of this means for central banks, because this is where the macroeconomic implications become particularly complicated. Central banks in most major economies have spent the past few years in a battle against inflation. They raised interest rates aggressively to slow demand, reduce consumer spending, and bring inflation back toward their target levels. That process was working slowly and unevenly, and several major central banks had either already started cutting rates or were positioned to do so. A significant oil price shock, driven by supply disruption rather than demand, puts central banks in an extraordinarily difficult position. Here's the problem. When inflation rises because of a supply shock, raising interest rates does not fix the underlying cause. You cannot drill more oil by raising the federal funds rate. What higher rates do is reduce demand throughout the economy, which can eventually reduce the inflationary pressure by making consumers and businesses spend less. But reducing demand in a supply-shocked economy also means reducing economic activity, which risks tipping the economy into a recession. The central bank faces a genuine dilemma between fighting inflation and protecting growth, and there is no policy setting that solves both problems simultaneously. The result tends to be policy paralysis or hesitation, which itself creates uncertainty in financial markets. Bond markets, which have been pricing in rate cuts, begin repricing the probability that rate cuts will be delayed or canceled. That repricing moves through asset valuations in ways that affect every investor holding interest rate-sensitive assets, which is essentially everyone. Financial markets do not react to supply chain disruptions in a linear or predictable way, but there are identifiable patterns in how different asset classes respond to this type of macro shock. Equity markets face a complex set of cross-currents. Energy sector stocks benefit from higher oil prices, at least in the short term. But industrial companies, consumer discretionary businesses, transportation companies, and technology hardware manufacturers all face rising input costs, margin pressure, and the risk of slowing consumer demand. The net effect on broad equity indices tends to be negative, with the magnitude depending on how long the disruption persists and how much it affects the inflation and interest rate outlook. Bond markets experience a tension between two competing forces. On one hand, a risk-off environment, where investors are uncertain about economic conditions, typically drives demand for government bonds as a safe haven, which pushes bond prices up and yields down. On the other hand, if the disruption drives inflation expectations higher, bond investors demand a higher yield to compensate for the erosion of their real returns, which pushes bond prices down. These two forces can coexist in the same market environment, creating unusual volatility in bond markets that makes the traditional safe haven narrative more complicated than it appears. Commodities beyond oil also respond, with industrial metals like copper facing the dual pressure of potential supply tightness from the sulfur and chemical disruptions and potential demand weakness from slower global industrial activity. Gold typically benefits as a monetary safe haven when inflation uncertainty rises and confidence in paper currency stability declines. Crypto markets, which have become increasingly correlated with broader risk asset behavior in institutional portfolios, tend to follow equity markets during periods of macro uncertainty, declining when equity risk appetite falls and recovering when risk appetite returns. Here is what the full picture of this disruption tells us about the nature of systemic risk in the global economy. The Strait of Hormuz is a single point of failure for a remarkable number of interconnected supply chains. That is not a new insight, but the degree to which those supply chains have become entangled with semiconductor production, battery manufacturing, food systems, and artificial intelligence infrastructure is a relatively recent development that makes the potential consequences of a sustained disruption more severe than historical models might suggest. The investors and analysts who focus only on the oil price channel are missing the deeper structure of how this shock propagates. The chemical supply chain effects, the energy availability effects on semiconductor production, the fertilizer effects on food prices, and the central bank dilemma effects on interest rate expectations are all part of the same event. They play out on different timescales and through different markets, but they originate from the same source. For anyone trying to understand what is happening in financial markets during a period like this, the most useful discipline is to map the system rather than to react to the headlines. What connects to what? How long each transmission mechanism takes to work through the economy? Which markets are pricing the shock already and which are lagging? The investors who tend to navigate macro disruptions most effectively are not the ones who make the biggest bets on the most obvious outcomes. They are the ones who understand the full structure of the risk well enough to know which parts of it are already priced and which parts are not. That kind of understanding does not come from headlines. It comes from studying the systems that underlie them. This video is for educational purposes only and does not constitute financial advice. Nothing discussed here should be interpreted as a recommendation to buy, sell, or hold any financial asset. Always conduct your own research and consult a qualified financial professional before making any investment decisions.